Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So with the Federal Reserve no longer able to cut interest rates and probably not interested in cutting interest rates, and many interest rate cuts priced into the market for the ECB, for the Bank of England, for the Reserve Bank of Australia, for the Reserve Bank of New Zealand, where does that tell us their currencies should head? Lower. Because when it comes to the number one driver of the currency market, it is interest rates. And it is not the current value of interest rates because, you can see from this table here, Australia has interest rate that's, 500 basis points higher than the U.S. interest rate. But it is the future direction of monetary policy, the future direction of interest rates that is what is driving the markets. And I argue that the dollar has further room to rise because not everyone realizes this. Not everyone has priced in or put on their euro short trades in anticipation of a rate cut because the ECB hasn't cut rates yet or haven't given us a strong enough signal that they would. Not everyone has put on the short pound dollar trades in anticipation of a Bank of England rate cut or another Bank of England rate cut. So as the market gets closer and closer to pricing these in, that will translate into more and more weakness for the respective currencies. Now, of course, the pound dollar, the euro dollar, the Aussie dollar has fallen significantly. And because it's fallen significantly, I go back to what I said in the beginning, which is that further losses will be slower, and they won't be as one directional as we've seen them in the past. There will be corrections or relief rallies, but expect 140 to still be broken in the euro dollar. Expect the pound dollar to head towards 170. And this next slide just shows you that trading currencies is all about an expectations game. The man on the left, Ben Bernanke, is expected to hike interest rates for the first time in 2 years. That's the next move that he'll be making. The man on the right, ECB President Trichet, is expected to cut interest rates for the first time in 5 years. When he begins, it will probably not be just a one-off rate cut. So that is why I think that the dollar has more room to rise. Now, I get a lot of questions these days looking for levels from people. And there's, many different technical levels I can give you that will provide, near-term support for the various currencies. I mean, for example, 140 is obviously a psychological point for the euro dollar, followed by 135 where we have some formal lows. But from a fundamental perspective, I've been writing about this on GFTforex.com about what the fair value for the euro dollar and the pound dollar is. And what I mean by fair value is that when does the euro dollar and pound dollar become a value play? When does it become a good bargain? When is it properly valued? So what I did is I went back and took a look at some of the OECD data on purchasing power parity. And let me actually, if you go on to GFTforex.com and you just basically click on let me see where it is, the resources tab. On the right-hand side, you see my name come up, and just click on Kathy Lean. I still have my report from yesterday up. I'm going to put up my report today after our webinar. But if you scroll down to the euro dollar and the pound dollar section, I say that taking a look at the OECD values, which were released earlier this month, the euro dollar does not become properly valued until 110, 120. The pound dollar does not become properly valued until about 165, 160. If you've heard of the economist Big Mac Index, which is another way that people like to take a look at purchasing power parity. That makes an even bigger extreme because according to the Big Mac Index, which was last released in July, the euro-dollar was 50% overvalued. So if you take a look at that number, that means that the euro-dollar does not become a bargain play from a PPP perspective until it hits parity. Now, don't go ahead and sell euro dollars and pound dollars because PPP, or purchasing power parity, has a ton of flaws. Doesn't count for the quality of the good that you're getting. It basically measures a select basket of goods. There's a whole slew of problems that come with PPP. But what it does give us is a reference point. And it does give us a reference point from where the euro dollar and the pound dollar could be properly valued at from a fundamental perspective. Therefore, from that perspective, and the fact that technical picture is still bearish, from all the reasons I gave you earlier on the outlook of the U.S. economy and the outlook of the global economy, those are all reasons why I think that the euro dollar will continue to fall and the pound dollar will continue to fall. For the person that's just asking about what the web address was, it's gftforex.com. You can click on Boris's picture on the right, and then if you look on the right bar, you'll see my name, and you can click on my picture. I'm putting up my article later today. So let's move on to risk aversion. Risk aversion is what's mattering the most to carry trades because when people are risk averse, they don't want to be in carry trades. When they have a healthy risk appetite, their appetite for carry trades is voracious. So risk aversion is skyrocketing these days, and people are, tension is really, really a big problem in the global markets because Bill Gross, the legendary PIMCO bond fund manager, warns that we could be facing a financial tsunami. I mean, he did give this warning before the monumental announcements on Fannie Mae and Freddie Mac, but today's 280-point sell-off in the Dow and also sell-off in the carry trades tells you that the market does not believe that the Treasury's bailout is enough. And that is point number 2, which is that Fannie and Freddie's bailout may not be enough. Granted, it was a huge announcement, but we also had a story today about how Lehman Brothers could be facing capital problems. Basically, they were in talks with the Korean Development Bank for a capital infusion, and those talks broke down. So if Lehman Brothers ends up having a capital problem just like Bear Stearns, we could certainly see another repeat of what happened in the first quarter and the beginning of second quarter. Also, Goldman Sachs is set to announce their earnings next week. And write-downs are going to be huge. Write-downs are not over. Mr. Doom, Mr. Norio Rubini, who predicted a recession or slowdown in the U.S. economy years before anyone else did, when everyone else was still, riding high on carry trades and Dow movements and all those things. He was starting to warn of a recession. And he told us that there's probably another 50 to 75% more write-downs that have not been announced yet before the banks are over. So risk aversion is out there in the markets because there's still trouble in the financial sector. And to some degree, those job numbers scream recession. The U.S. number that we had last Friday is at pretty bad levels. And going forward, we could have more problems with corporate earnings. One of the, today my article is going to come out, so I'm going to talk about after this discussion on gftforex.com, it's going to talk about the pros and cons of dollar strength. And one of the cons of dollar strength will be weaker corporate earnings. Because when the dollar was weak, what it did was it created a big boost, not only for exports in the U.S., but for the foreign earnings of U.S. corporations. If you take a look at a lot of the earnings reports that came out last quarter, some big surprises were attributed directly to currency movements.
Thank you for listening to our podcast.